The question is, how much are those dollars going to be worth? And the answer is not that much, because remember, the dollar is still a derivative. It's a derivative of real money, and real money is gold, and below that is silver. At the end of this, it's one of two possibilities. Either 95% of people lose all their deposits, and then whoever is left has, let's say $35 an ounce per in gold in dollars, or everyone has all their nominal deposits and you have $35,000 an ounce, and nobody but the stackers has any real money. But it's probably going to be that one. This is why we prepare as we do. But even if it's the other way around, it's not going to change gold's purchasing power. There's still going to be the same amount of stuff available and the same amount of gold available. So that's not going to change.
Many experts agree that gold will likely increase in value in 2024 and continue to experience long-term growth. We are expecting gold to be pushed higher by a Fed easing. Also, this comes with a weaker dollar, said the investment bank's precious metal strategist Joni Teves, who expects the metal to hit $2,200 per ounce by the end of the year. Rafi Farber from the Endgame investor stresses the dollar's ties to gold and silver, predicting a future where 95% may lose deposits, lowering gold to $35 per ounce, or a weakened dollar scenario, lifting gold to $35,000 per ounce. Meanwhile, Rafi dismisses the significance of deposit safety, asserting that every bank will be bailed out nominally. As of January 31st, the balance in the BTFP stood at just over $165.2 billion. That was a slight decrease from the peak of $167.8 billion the previous week. The fact that banks are still tapping into this bailout program nearly a year later is another puff of smoke. Unfortunately for the banking system, the BTFP goes away in March unless the Fed decides to extend the program. Regarding tangible assets like silver coins, Rafi underscores their value over digital currency. In a post-crisis scenario, he envisions those with tangible assets like silver having an advantage over those holding depreciating dollars. Silver remains an attractive investment option in 2024, mainly as a hedge against inflation and other economic uncertainties. When the government prints too much money, the value of the paper currency tends to decline, and prices go up. In this scenario, buying silver can be a smart move to protect your purchasing power and diversify your portfolio. Moreover, Rafi acknowledges everyone's role in weakening the dollar and suggests wisely investing in precious metals. Now we present the clips of Rafi Farber's insights. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I think the safety of deposits is irrelevant. You don't really have to worry about the nominal dollars in your bank account. Every bank will be bailed out nominally. I have no doubt about that. They're not going to let a single bank really fail where depositors don't get 100% of their dollars back. The thing is, the question is, how much are those dollars going to be worth? And the answer is not that much, because remember, the dollar is still a derivative. It's a derivative of real money, and real money is gold, and below that is silver. At the end of this, it's one of two possibilities. Either 95% of people lose all their deposits, and then whoever is left has, let's say $35 an ounce per in gold in dollars, or everyone has all their nominal deposits and you have $35,000 an ounce, and nobody but the stackers has any real money. Which it's probably going to be that one. This is why we prepare as we do. But even if it's the other way around, it's not going to change gold's purchasing power. There's still going to be the same amount of stuff available and the same amount of gold available. So that's not going to change. Don't worry about your deposits. Just worry about what they're going to be worth, and keep stacking responsibly, slowly but surely. And the more you stack, the more outside of the system you are, and that's how you stay safe, at least monetarily. If we're talking about a silver coin, right, versus, let's say, a digital number in a bank account, when you log into and you see a number on a screen, you have $1,000 versus you have $1,000 in weight in silver. If you start young and you make kids understand what money is and what saving really is, like saving real hard money, it's a shiny coin. It's even more of an instinct to hold on to it, to save it, as opposed to like a dollar bill, which is it's nice, but it's just a piece of paper. As opposed to, even further from that, a derivative of that, which is a number you see on a screen, right? So if you train your kids to earn silver or to earn real money for chores they do around the house, then they become immune to this despair, nihilism that they see when the monetary system is falling apart, because they say, look, I have silver, it's going up. So this is the reason that they're becoming so despairing is because they don't know what money is. And our job when this is over is when their dollars are no longer worth anything and they have like a tote bag from the splurge that they did today to make themselves feel better, then we can say, okay, we have money, we can start over. And even these people, they have their role to play, right? There's no qualitative difference between emptying your dollars to buy a tote bag and emptying or some luxury item, some luxury consumer item, and emptying your dollars to buy gold and silver. I'm not saying to empty them, but we need everyone to come in and empty their dollars for anything they can, and that means the dollar is dead. We're just doing it more responsibly than they are, but they're coming to the conclusion that we're coming to, just in a much more superficial way, but it's essentially the same thing.
Rafi Farber outlines the Bank Term Funding Program and predicts the ending of BTFP could speed up challenges in the banking sector and repo market, similar to what was witnessed in September 2019. The RRP has since fallen to roughly $680 billion too, down 73% from its peak, and could be fully drawn by the end of 1Q 2024. At that point, the government may have to finance itself by issuing coupon-bearing debt, which could drain further reserves from the banking system. While inflation affects everyone, Farber contends that the shift to hyperinflation reveals a stark reality for all. Wisdom Tree's forecast currently projects a 3.1% inflation rate at the start of 2024 and a 2.60% rate by the third quarter. This persistently high inflation could push up demand for gold and, subsequently, gold prices. Farber encourages using physical cash for a personal connection to money. During crises, trading gold or silver enhances this, raising awareness of real acquisition value. Let's get back to the interview.
Quantitatively, the Bank Term Funding Program, just in very simple terms, is banks can give the Fed all their treasuries and then get the face value of it in a loan for a year for the reserves. And those reserves have to be paid back. So numerically, what it means is the Bank Term Funding Program started on March 11th, ends on March 11th, but most of the loans, the big chunk of the loans, were made by April 5th, and those have to be paid back. And I think it's something between 70 and 80 billion dollars of loans were made by April 5th. So if the program is not renewed, we're going to have to see the equivalent of about $80 billion in quantitative tightening, QT, when these loans are paid back. Because when a bank, let's say, pays back the loan to the Fed, and then they get their underwater treasuries back because it was a swap, then all the money, all the dollars that they pay to the Fed to pay back that loan, those dollars go out of existence, right? They're not spent by the Fed back into the system. That would be QE again. So quantitatively, we're going to see something between 80 and $100 billion of quantitative tightening by April 5th. And if there are no more reverse repos in the system and they're draining fast now, I think they're down, the last time I checked was a few minutes ago, I think it's 500 billion now, so we're down to our last $500 billion. There's going to be a crunch probably in the repo market, probably in the overnight lending market, like something like we saw in September 2019, but not exactly that. I don't know exactly what it's going to be. It could be more banks failing, just like we saw with New York Community Bank Corp, I think it's called. That was yesterday. I think they didn't collapse completely, but they had this big loss, $150 million loss from an office loan that went bad, a single office loan, and a co-op loan. There's so many banks that have a lot of office loans, commercial real estate loans, that if one of them goes bad, all of a sudden what they thought was going to be like, let's say, a $300 million profit for the quarter, or for the quarter, ends up to be like a $300 million loss, and then investors don't know what to do, and they sell the bank, and then you start a contagion. This is definitely going to cause a contagion at some point, and the cancellation or the ending of the Bank Term Funding Program is going to speed it up. In the most basic sense, the lie of inflation makes you think that you have more money than you do. It will incentivize you to buy things that you can't afford, and then all of a sudden the dollar is worth very, very little, or you'll go into debt and all of a sudden the dollar is worth very, very little and you're stuck, right? Because you were living a lie. And we're all victims of that, no matter how slow inflation is going. The difference between an inflationary system where people are still functioning and hyperinflation where it's over is not that people are becoming more poor. It's just that reality is revealing itself finally. And then once people tell me that let's say they go on a diet where they're only spending cash and not using credit cards, right? Then even then they have a more personal relationship with what money really is, even though it's not quite gold and silver. It's closer because it's something physical. And then they have more of an appreciation for resources, whereas if they spend something, they appreciate it more because they actually have to take the paper out of their wallet and give it to somebody, and now their wallet is lighter, right? With gold and silver, it would be even more extreme. Imagine what you would feel if in the end game you had to buy a house for your family with 6, 7, 8 ounces of gold or whatever it's going to be, and you have to, like, these coins that you've been stacking for so long, you have to give them up to somebody, and yeah, you get a house. You're very proud of yourself, but you're going to value this house a lot more, let's say, than if you had like a 30-year mortgage on it and you're paying $2,000, $3,000 a month to a bank. You'd still value it then, but if you buy it with your own real money, it's going to be even more valuable. And it just gives you an idea of what things are actually worth in your life, and to appreciate them more and to be connected more to what you acquire, not with credit, but with hard money. And it gives you a connection to reality, and it calms you down.
Considering an annual growth rate of 11.2%, an ounce of gold could be worth about $2,251 in 1 year. In 5 years, an ounce of gold could be worth about $3,441, provided that the value continues to grow at a rate of 11.2%. How can individuals strategically position themselves in response to these predictions? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.